Um, Take a little bit of time to get oriented, right? When it comes to trading, it would be really great if we could just come in, be new to trading and just see a particular thing turn red or green and be able to take a trade and everything would be great, right? That just sounds really good. It just doesn't work that way. As a part of your Bullish Bears membership, you have access to a lot of resources, an overwhelming amount of resources, actually. When I was new, I knew what I needed to do, right? I knew what I needed to work on, what I needed to focus on, because it matched my account goals. To get to our live stream Zoom, if you're in the Discord, you can click the link that I just shared in the chat. If you're not on our Discord, you can enter the Discord by logging into the Bullish Bears website. Go to the Get Started or go to the Trade Rooms. If you go to the Trade Rooms, there's the Zoom link. If you go to the Get Started, it will help you get to our Discord. So that'll kind of help get you guys pointed in the right direction. As I mentioned in the morning briefing, let's just take a moment to look at what's going on in the futures. We had a little bit of a rally in the Globex hours. Globex is from 6 at night until 8 in the morning. And then we go into pre-market from 8 to 9:30. In the Globex, we had opened, gapped up in the futures. So this is the S&P futures market, the ES. We closed Friday down here, opened Sunday night here, and we were maintaining that gapped up position. And then we really got a nice little boost before fading back. Now, it's not much of a surprise that we got that little bit of a boost. Markets tend to aggregate and expand. It's why the megaphone pattern is so popular. So, one last hurrah, a little bit of a bump to the upside, and now we're fading back down. There is a little bit of a concern that we may attempt to close a gap. So when markets gap, they don't like to leave that gapped market behind. You can see that the bonds are really shaking loose this morning. Another thing that I mentioned in the pre-market briefing, that you want to pay particular attention to the bonds and the dollar, because this will really give you a heads up on what's going on. And I even mentioned how there are times in history where the bonds and what they say stock and bonds are both moving in the same direction. But look at the the S&P 500 futures and the Nasdaq 100 futures are both moving down, and the bonds are moving down at the same time. And the dollar is making an exaggerated move to the upside, and so is the VIX. We have to watch that dollar, because if it starts correlating with the VIX, then it's showing global assessment of risk, right? Institutions around the world, if they deem that that there is a lot of risk out there, they'll start aggregating to the dollar and bidding the dollar up. So, it's a very simple thing. You just bring up the VIX, bring up the dollar. Does it look like they're moving in tandem? Yes. Okay, then that's what's going on. It doesn't necessarily reflect what we're going to trade. It's like, oh, wow, the dollar's going up. Let me go get into, whatever. It's just more of an idea of, hey, well, where's this coming from? Where's this move in the S&P or the Nasdaq, the Russell and the Dow? Where is this coming from? And when we see that it's global, maybe we change what we're looking at to try to find that news. What news came out that made this do that? Speaking of news, um, I created this Twitter Discord a long time ago because I really hate Twitter. No offense, Twitter. I just don't like it. I definitely don't like it on my phone because when my phone makes a noise, I assume that one of my family or friends are trying to reach out to me. A text, a message, something, right? So I don't want my phone blowing up all day with stuff coming at me from Twitter. I created this Discord and I put a bot in it that monitors different Twitter accounts. And when one of those accounts tweets something, this bot gets that tweet, brings it back, and lets me know about it. And so, as you can see, there's no commercials, there's no advertising coming at me. If Bloomberg tweets something, it lands here. I can see it. Finance Juice, Breaking Live. These are all really good Twitter feeds to have. I just don't want to go to Twitter to look for them. So the bot does that work and brings it back. These are the two main ones that I personally focus on, but I knew that I was going to share this place with others, so I put other things in it. TD Ameritrade has 20 and 30-year CMT veterans that make content and post things on Twitter. You'll get familiar with their names, like Barbara. She's absolutely amazing. She does like small account options stuff, and it's straight from TD Ameritrade. And you find them on YouTube, and you find them in Twitter, and I mean that's so cool, right? So they'll put information out through the day, and I don't want to have to go get it. The bot does that, brings it back to me. So now in the pre-market, we see this dropping off, and we want to kind of know, hey, what's going on out there? What is causing this drop off? It could be nothing more than the fact that Tesla is starting to pull back a little bit. But Tesla's not pulling back, right? Tesla is continuing that bump to the upside. Okay, so it's not one of the FANG names. On the 30-minute time frame, Nvidia has a little bit of a trend, and Tesla has trend and momentum. So we know it's not those two FANG names. Could be Microsoft, Apple, or Facebook. Those names are all big enough to weigh down the market. Could have been some of the economic news that was on deck. We do have PMI manufacturing at 945. A new trader question that I get all the time: what time frame are we talking about? Just a very simple answer to this: Eastern time, market time. Nobody cares where you live. Nobody wants to ask you what your time frame is, and nobody should have to ask me what my time frame is. We're all trading the same market. We should all talk in Eastern time. In my office, everything is Eastern. I don't live in the Eastern seaboard. I don't live in the Eastern time frame, and yet every clock in my office is set to Eastern time. The only time frame used in my office is Eastern time. So if you see a Zoom stream link or a discussion about a live stream this afternoon at 2 o'clock or whatever, and you're trying to discern what time frame is he talking about, Eastern time. So Thinkorswim doesn't do a really good job giving us pre-market movers. I mean, it has some built-in stuff for that. It just doesn't do very good. you're better off using an external source to get that information. TrendSpider, TradingView, something, right? Something better than Thinkorswim. Now, once the bell rings, it's not a big deal. We can use Thinkorswim and see changes on the day. Change percent is really what I'm looking for. If you're new to trading, focus on percentages. It will help you a lot, right? Because if we say, oh wow, SPY moved $2 today, $2, is that good? Well, if it's X still and it moved $2, that may be pretty darn good. If it's Amazon and it moved $2, that's nothing, right? So $2 doesn't really tell us much. But when we talk percentages, then we have a better understanding of the magnitude of the move. It takes a little bit of getting used to begin speaking that way, looking for change percent. So this morning, for an example, in the Dow Jones, which is a 30 name marketplace, how many companies are up, how many are down, and by what magnitude? JP Morgan is up around 1% this morning. You can see how we've got this range here. JP Morgan is getting very close to the top of the range. We're looking at an inside day breakout. And if we were to take it out to the higher time frame, this is looking like a red to green with an inside day breakout. Yesterday was a red day, closed in the mid to lower portion of the red day. And the way I like to trade these is I want to see a rally up in the pre-market at least as high as yesterday's open, right? So I want to open at least as high as yesterday's open. That green line that you see there, that is the 20 period moving average. I color code my moving averages. It's a little tip that I would give everybody out there. Set your colors and then never change them. The 200 is purple for me. The 20 is green. It never changes no matter what broker or what platform or what charting software I use. Every time I see a green moving average, I know that that's my 20. At first, you may struggle trying to pick what colors you want to use, but once you teach your brain to see those colors and instinctively know what they are, it's one less thing you're stuck thinking about later in the day, right? You come across the chart, you're looking at the colors and trying to figure out, man, wait, what was that moving average again? Now, I don't remember. Then you got to go look. It's just one more thing that's leaving you behind. And yet, if you color code everything short, simple, and sweet, and those colors, they only matter to you. So you can make them whatever color you want. If you have multiple time frames on the same screen, like a 20 period daily and a 20 period weekly, they would both be green, but then maybe you would want to change the line type. One may be a dotted line, one may be a dashed line, one may be a solid line. And then you can still see that, yep, they're both 20s, but one's a 20 daily, one's a 20 weekly, it goes a long ways to kind of just quickly aggregate data because as traders, that's really what we need to do, right? We need to aggregate data. So it really looks like we're going to see a red to green, not just in JP Morgan, but in financials this morning. So I would really be keeping an eye on financials this morning. You may see an opportunity for a trade. I'm going to load up one of the brokers. And yeah, I said one of the brokers. I use more than now 15 different brokers. It used to be 12, it's now 15. 15 different brokers and more than 30 accounts. Gets to be a little much after a while. Not all of those accounts are for the public consumption, but when I'm streaming and I'm trading live, I do it with live accounts, real money, and I want to be able to show those brokerages everything that's in them. I don't want any private area where I say, yeah, but I'm not going to show you that. So, for an example, this broker that we're on right here is one of those public brokers. I don't hide any aspect of it. That way, everybody can see that it's real, it's live. There's no paper trading. Now, Tastyworks doesn't have paper, but some of the other brokers that I use do have paper. And I don't want people to think that I'm pretending to trade when I'm not. I will trade live paper, and I'll show specifically when it's paper, and I will tell everybody, hey, this is paper, it's not live, or it's live, it's paper, it's just not real money. I will do that. There's a time and a place for it, but generally speaking, I'm not going to be trading paper. The reason for that mainly comes down to the idea, if I put out a trade alert and I tell someone, hey, this looks like a really good trade, um, I'm going to take it. I see a lot of those trade places out there who put out an alert, and for an example, they'll say something like, oh, we're going to go, you should go long Microsoft, right? And they'll put out a buy alert for like Microsoft. And then when you ask them, did you take that trade? Are you also trading Microsoft? Oh, no, we didn't actually trade it. We just think that you should trade it. Well, forget that. You know, if it's so darn good that they think it's good enough that we should trade it, if they're putting out an alert saying this is a buy entry right here, why are they not buying it? Right? They want us to put our money on the line. So when I turn on the broker and I'm trading live, I make sure that people can see and understand that is a live broker. It's not pretend. Strategy is something that we talk about frequently. When should I get a trade? And what should that trade look like? What's the criteria? What's the conditions? How soon should I get in? The financials this morning are presenting with a red to green, and we will be looking for an inside day breakout. That is a combination of multiple strategies. Let's look at JP Morgan. We can mark JP Morgan's low from Friday, its high from Friday, and the open and the close from Friday. What we're looking for is that it is gapped up at least as high as yesterday's highest point. Check, done. We know we can see that, right? It closed in the lower portion, or it closed red yesterday. Check, yes, that's two, right? Red to green, inside day breakout. We could add something like a major moving average. We are underneath that purple line. The purple is the 200. We were underneath the 20. We've rallied above it in the pre-market. So that is a cross up of the 20 period daily moving average. We can see that daily moving average on the intraday chart. Load the indicator called daily. We want the daily close price. Since it's green, or since it's 20, I want it to be green. Going to make it big and fat so it sticks out. Now, when we come back into the intraday chart, all these green dashed lines, these here, that is the 20 period moving average on the daily chart. So you can see how price came in up from these lows, interacted with that 20 period moving average for the last 5 days, and we are now breaking out of the range that we have been in. That range came all the way back here. There's the high of the range, there's the low of the range, and we're above that 20, the 20 daily moving average. So red to green, that's one trade setup. Inside day breakout, that's another trade setup. JP Morgan has an average daily range of 1.62%. If we're looking for an above average move today. That it's not just wow, but damn. Then we want to aim higher than its average, right? If it generally moves 1.6% on any given day, and we're looking for something beyond the norm, then how about we aim for at least a 2% move? That way we know what options to target. It's already moved 1% in the pre-market, so we could expect to see at least 1 more percent. From our current location, we just use the drawing tool and move 1%. That puts us at around 1.65, 161.5. Well, I said that all wrong, didn't I? So, we don't want to go in and price those 162 calls. 162 calls, they're not overly expensive. Getting a little bit of a rejection. So, first thing in the morning when the bell rings, what we normally want to do is give the market a little bit of time for some price discovery, right? It's got to absorb all of the news from the overnight hours and kind of price that into the market. On Mondays, this can take anywhere from 30 minutes to an hour and a half. We never quite know how long it's going to take, but we want to give the market time to do that. Now, another indicator is if we didn't have enough that we may want to turn on here is the VWAP. Generally speaking, I like my VWAP to not have the bands showing. I don't really need those. And since my VWAP is always purple, I need to distinguish it from the other purple line, which is the 200 period moving average. So I'll make it dotted. That way I know it's my VWAP. Now, if you're wondering what those red and green dashed lines are, that's a 4-hour high and a 4-hour low. In the last 4 hours, where was the highest point and the lowest point? That's all that it's asking. All right, so we can see the financials are kind of shaking up a little bit. Let's go take a closer look at those financials. We want to look at the financial ETF XLF, and the names that make up that ETF: Berkshire Hathaway, JP Morgan, Bank of America. Wow, Bank of America, huh? That's a nice rip there. Wells Fargo, Citigroup, Goldman Sachs, Morgan Stanley, and BlackRock. Now, when we say the word finance, that's kind of vague. Are we talking about credit cards, lending institutions, insurance, trading firms? The finance is what part of finance, right? So when you are on there, you can look at the industry or the sub industry, kind of help narrow things down a little bit. It's kind of narrowing things down a little. All right, so Bank of America. Let's go take a look at Bank of America. It seems to be doing pretty good. We want to do a top-down analysis, so we start with the higher time frame, mark out that weekly expected move, which is 45.7. Doesn't need to be perfect. We just get a line drawn somewhere in the general vicinity of that. Recognize that we are at an area of resistance. Mark a little bit of support. And look at that red to green setup, huh? Bounced on the 20 period moving average, had a red day yesterday, rallied up in the pre-market above not only yesterday's high and not only above yesterday's open, but entirely out of this range. So we're going to be looking for a 4% move in Bank of America today. 4% is my go-to for a wow day. If the average daily range is 1.7, we're basically multiplying that by 2, right? It's got a market maker move added to that too. So we would take 1.7, add market maker move. That put us at around 2.25. Double that, we're at 4%. I want to see a move in Bank of America around 4%. And we would target those options at around 4%. These are really cheap options too. You know what I mean? Like we don't even have to put on any kind of spread to be able to afford these. Try to split the mid on that. I'm going to try to get them for 5. I don't think that I'm going to get loaded for 5, but it's worth a shot. Y'all with me this morning? I'm not seeing any kind of chat. Maybe y'all fell asleep or something. Happy New Year, everybody, by the way. All right, so that thing is literally just taking off without me. Those options are priced so high now. I got to see some kind of pullback before I get into it. But that was a really nice setup. I just wasn't fast enough. You know, if I had spent less time explaining and more time trading, maybe I would have caught it. But, you know, my first goal is to help you guys. The second goal is to find my own trades. So I can get a trade at any point. It's no big deal. So Bank of America is still looking really good. There are some concerning areas, right, that we talked about already. Um, this line in the sand here ties back to this really big monster candle right before dividend. It's kind of the controlling range in all of this. We are still underneath that 50 period moving average. That needs to be pointed out. A market that's underneath the 50 still is considered to be at risk. So you can see now in better detail where that risk is, right? That is a major pivot point that needs to be resolved. There's a lot of liquidity at that area. I am long in JP Morgan in a call. Um, I got into that call for $38. It's going to expire Friday, January 7th. What I'd like to do is add a short leg to this. If I can get the 165 sold for more than I paid for the 162.5. Considering we're fading back at the moment, that might not be possible, right? But that way I can hold it through the day and maybe turn it into a swing trade. For right now, we're still inside this trouble here. I mean, we're out of it, but we're not candle closed. And until that candle closes, we're not confirmed out of the move yet. Right? We're not out of the woods yet. Maybe I picked the wrong product, right? I didn't get filled in BAC because I wanted to be a little more particular in what I paid to get in and missed my move. But this one seems to be doing better than JP Morgan is anyways. We also have Wells Fargo doing really good this morning. The trading firm BlackRock is not doing so hot. Morgan Stanley's looking really good. Goldman Sachs and Citibank. So when it comes to the banks, they really liked this move in the bonds this morning. And you got to remember, that's our focus, right? When we're trying to trade, we're trying to look for the why behind it. Because how long is it going to last? What's driving this thing? Where's the fuel coming from? What things should I be looking at for an opportunity to trade? And when these bonds dropped like that, that really got my attention, right? When bonds go down, interest rates go up. Banks like that, and the banks are responding. But tech does not like that. Um, so far, the NASDAQ is holding, but the NASDAQ has more than just big tech names, right? The dollar stabilized and is making its move back up. It is not connected to the VIX. We can see that, right? The VIX is making a move to the downside and the dollar is making a move to the upside. The Dow kind of holding its range and the Russell testing against that Globex high. So we're very bifurcated in the market this morning, kind of all over the place. We know how good we're doing in finance, but what else is going on out there? The easiest way to do that is bring up the sectors. Energy is leading the way, and banks and energy were really nicely correlated last year. We don't know if they're going to continue to do that, but so far it looks like it. XOP is the energy ETF for exploration, oil and gas exploration. You can see we've got an inside day breakout on a red to green here. We had a red day yesterday, and we gapped up in the pre-market and then rallied outside of yesterday's price action. We're still in the range from last week. So, we don't have a inside week breakout yet, but it's looking really good. Good start. Airlines also are up really well this morning. And talking about ranges, airlines are getting ready to leave the range. Now, there's been a lot of talk about casinos, cruise lines, resort hotels, airlines, and about how beaten down they are and how they're cheap. They're on sale for long-term investments and swing trades. I really want to caution people on that. Okay, when it comes to a company and whether it's going to do good, it's not just the chart, right? Companies borrow money, and when a company like the airlines have a negative credit rating or a lower credit rating, the money that it costs them to borrow money is expensive. So they got to show that they can make a profit. Airlines are notorious for wasting money, needing bailouts, you know, uh, bad management. So yeah, I mean they're beaten down. They look like a good buy for a swing, but you could be waiting for a decade to get some kind of return. Right now, if you're using a long-term account, maybe something you're going to give to the kids someday, sure, why not? Buy them some airlines or whatever. But if you're looking for like a 1 month turnaround or a 2 month turnaround, go read their earnings statements and really see, their expectation of profit going forward. Another energy ETF that I use is XLE. This is more of a broad energy one rather than just exploration. If we use the regression line and we just start at the highest point of the last leg and draw it across, you can see the sine wave as we crisscross back and forth through it and how we've broke rank, right? This is the highest area. We're getting that crossover. We're now presenting with higher highs and higher lows where we were getting lower highs and lower lows. So a little bit of a change in crossover there. If we did the same thing from back here, use the regression line, start at the lowest leg and just draw it across to where it turned. You can see that sine wave, just a little bit of a visual. So let's kind of flip over a little bit and ask from the other side, what's not doing really good today? Biotechnology is not looking too hot this morning. Now, for the last year, we've had a relatively decent range from the 170s to the 140s, just kind of, back and forth, back and forth. In the grand scheme of things, we were holding this base down here. We broke out and changed lanes, and now we're building a new base up here. These bases are on a weekly chart. They can last for a long time. No idea, right? What we can say is we're not at the low of the range and we're not at the high of the range. So, if looking for a day trade is one thing, trying to find a swing trade, completely separate discussion. If I wanted to put on a swing trade right now in biotechnology, it'd probably be focused something more on like an iron condor, right? That way we could perhaps target something like an out of the money call spread here and an out of the money put spread there, looking for price to maintain in between those. I don't like using out of the money credit spreads by themselves. So I wouldn't want to go on and just put on like a call credit way up here without something else, right? Which is why I like the iron condor. That way, combined, I may get something that can price me in near a 1-to-1 risk to reward. It's still a really wide range. And, depending on what we see out here, let's start with January. Just kind of price it, right? We never quite know until we start to see some numbers. So that's $3 wide on the put side. We'll flip over to the other side and run it about $3 wide as well. It's going to turn on some delta just so I can start maybe near a midpoint. So $3 wide on each side. We're getting a lot of credit here, which tells me I'm probably too narrow. We'll go ahead and throw it in there anyways. That looks pretty narrow to me. The gray area that you see is a 1 standard deviation. We're asking, what's the likelihood that price will stay inside the box? 70%. How big is the box? From 157 to 142. $15 range. So we'd probably want to spread this out a little bit. Of course, when we spread it out, we're going to increase our risk and decrease our profit potential, but we're also going to increase our chances of being right. A lot of traders get hung up on being right. They want to have a winning trade. They always want winning trades. Nobody ever wants to even think about a losing trade, right? Who wants to lose? But when you're trying to develop a trade opportunity, you have to recognize that having a high win rate strategy means you're going to have a very low profit opportunity. Had a request for the futures. This is mostly because there are no futures today, right? There's no one streaming in the futures channel. So everybody wants futures to be streamed here since there's no futures being streamed there. There's your low, ties in right back here. Now, the really cool thing about being a day trader is it doesn't matter, right? If we're looking at SPY, we're looking at ES. If we're looking at the QQQ, we're looking at the NASDAQ. That could be the INDX, the QQQ, the slash INQ. They're all the same, right? Not penny to penny perfect, but the NASDAQ is the NASDAQ is the NASDAQ. The S&P is the S&P is the S&P. So what are we going to do with it? Well, we tagged that low. First touch says we bounce off of it. We already did that. We missed it. We were too late to the game. Did you trade it? Because if you were watching price move towards that pivot, you were literally sitting there waiting for a trade opportunity. It just gave you one. Did you trade it? And if your answer was no, I was scared, you're trading too big. If you were scared to take this trade, it's because you were scared of the amount of money that you could lose. And that means that you are trading too big. Make your trade smaller so that you're not scared of a loss. Because the thing is, losing is a part of trading. And if that was a good trade or a bad one, you will never know until after the fact. So if you can't know in advance, then you trade the setups that you see when those setups come along. And you manage your risk. Now that you've missed your trade opportunity and it is gone, now what? Well, there are a few other pivots that we can focus on. One of them is where we closed on Friday. You see that close way down there? Well, that's not the line that I thought it was. So we have a close way down there. The first time we interacted with that close would have been an opportunity to trade. And then there is the Globex open. Those are legacy pivot points or institutional pivot points. They're universal. The close is the close, and nobody can ever argue with you about it. That means you can't do it wrong. I get people ask that question all the time. Did I draw this pivot point in the right place? Well, that's one that you can draw, and you would never have to ask somebody else to validate what you're doing. Did I do this right? Did you mark the high of yesterday? Yep, then you did it right. How about the low? Did you mark the low of yesterday? The close? Those are all institutional pivot points. And when we revisit those levels, it is very likely going to have an opportunity to trade. Now, recognize the violence, the size of these moves. There is a perspective that says if you're new to trading, this should not be what you attempt to trade, that you should not be trying to trade this. Because in good, clean market conditions with good, clean price action, you have good, clean setups. In violence like this, the only thing you have is a parachute. You jump out and hope it works. And you have to use a really wide stop unless you're really, really good at reading flow. And even if you are good at reading flow, this thing is moving so fast that you're very likely just going to get run over. Look at those big bubbles in volume. The amount of resting orders here. We're underneath the VWAP, which would be that yellow line right there. And there are no white bars up here anywhere. There's no ceiling up here. You can see that as price fell away, all those orders that were sitting way up there just faded away with it. So where's the liquidity to the downside? That white bright bar down here. If someone was to get a trade in here, an institution, not one of us, They're going to look for where's the liquidity? Where can I find a lot of participants so that I can get filled? 47.50. So if I wanted to go long, I'm going to need someone to sell me an opportunity to get in. And if I want to go short, I need someone willing to provide that to me. Now, as I talked about in my live streams in the futures channel, trade the chart size that matches your risk. So for an example, if you're using a 6-tick stop, you're probably going to want a chart time frame that shows you where a 6-tick stop has an opportunity to trade. We've got a flag forming here, or a bear pennant. If we're looking for a failed pennant, then what we want to see is a market make that move to the downside and start to present and it could move anywhere in here, right? We just want it to maintain this low, kind of build a base until it finally breaks out at the top of that thing. And we're aiming to get back to the previous level. It ends up forming a cup. The bigger the base, the more it resembles a cup. If it's more V-bottom, then it's, like no cup at all. So you can see, we'll just kind of move this box down a little bit. If this is our controlling candle back here, we had our high set. So we were getting higher lows, equal highs. There's our breakout. We're looking for a Busby. And we're looking for a reciprocation. So Busby would look something like this. Notice how I keep drawing on the right side of the chart. Anybody can look backwards and say, oh yeah, that's what we did. Look, there was a head and shoulders. Oh yeah, look, there was a flag. Draw on the right side of your chart where there is not yet something. What is it that we're looking for? What's it going to look like when you see it? How are you going to trade it if you don't know what it looks like? If you don't have an expectation of what price is likely to do? So in your mind, you should be able to see what is likely to unfold. You wouldn't drive your car if you couldn't look out the windshield. Why would you get into a trade if you can't see where it's going? What does that trade look like? And then, of course, the old argument, but how do I know I'm right? You don't. There is absolutely no way to know for sure that your trade is going to work out. Even if it is a perfect trade, it can still fail. The best that you can do is manage your money, keep your losses smaller than your wins. And like for me, I trade with a very high risk to reward ratio. I don't need to be right even 50% of the time to make money on a day-to-day and a week-to-week basis. In fact, just to survive, I only need a 20% win rate. Anything above 20% is growth. Metals and mining are looking good. Nice strong break of the range. So we've got airlines, energy, metals, consumer discretionary, which that's looking a little weak. We may be seeing a little bit of a capital rotation coming in here. Let's kind of back up to a higher time frame on that for a minute. So we had that nice double top back in November. And just the way that double tops are supposed to, this one went farther than the previous one before rolling over. Now, IBD talks about that all the time, about how double bottoms and double tops should extend farther than the previous pivot. That's exactly what we had. And then a nice rollout, right? A nice fade to the downside. Now, when I'm streaming, I don't have the news on. So if somebody knows what is up with the fade down in the S&P, by all means, give me a shout in the chat. We can check the Twitter package. So at 9:45, U.S. market manufacturing PMI final, they had a forecast of 57.7 and the actual was 57.7. So no surprise there. It actually hit what they were aiming for. U.S. construction spending month over month, the actual is 0.4, the forecast was 0.7. So a little soft on U.S. construction spending month over month. I see that Tim just gave a shout out on a call credit spread for the airlines or the cruise lines, excuse me. Let's take a peek at what that looks like. So we go to the alerts, call credit spread expiring January 21st, 2022, sold the 21 call and bought the 25 call, collected $65 in credit. Now, this is a $4 wide trade, collecting less than 25% credit. So you're risking 65 to make, excuse me, you're risking $335 to make $65. And out of that $65 in credit, he's looking to collect near 50%. So maybe about $32. So now you're risking $333 to make $33. And it was closed, right? This isn't an opening trade. This is a closing trade. This was a bearish position placed on top of the market. Using a call credit means you're slightly bearish or, you know, bear neutral. Go in and look at CCL. You can see how we had well, that trend line is just way off base. We had this angled line. And after earnings, the market had this gap. It closed the gap, faded down, had earnings, had a nice rally, pulled back into a little bit of structure. This is the controlling candle right there. That's wrong day. It just gravitated over there. All right, that's their controlling candle. So I don't know. I kind of liked the original trade, and I'm not quite sure I see a reason to have closed it. Can you warm that up? Other than this fits exactly what I was saying in the futures. When your loss risk is so big that you don't give the market time to even prove you right, you just go ahead and jump out. Because, I mean, who wants to risk, $300 to make $30? Not me. And if I see any kind of risk that makes me nervous, I'm getting the heck out. This is a perfect example of a trade that is still valid. I don't see any reason to not go short against the top of this range, at least for a day or two, maybe even a week. But I would not be interested in risking that much money. So I understand why he closed. I think it's a good idea to get that risk out of the situation as soon as possible so that the loss doesn't get worse, right? And it could get a lot worse. It could get $300 worse. I'm not a big fan of those out of the money credit spreads, which I mentioned earlier when we were talking about an iron condor. An out of the money credit spread, you will win frequently, but when you lose, it hurts. So I would rather not win as frequent and make sure that when I do win, I have really good value. And when I do lose, that they're much smaller than my wins. To do that, I just don't use out of the money credit spreads very much. Good way to do that is just to do it at the money. And I made a video today for the Next Level Library that talked about trading vertical spreads at the money using something that looks like this. This is a red to green setup. All right, notice the setup. We closed in the lower portion of the red candle down here. On Friday, we gapped up in a rally pre-market to at least the previous day's open. And then we rallied outside of yesterday's price action. So red to green with an inside day breakout. And the target is the next pivot point. That's a really good trade strategy. I love that setup. It's frequent. You can find it anywhere. Even on negative days, you can usually find something with a red to green setup. When you get a red to green and an inside day, that's even better. But we're coming into an area where there is expected to be a lot of resistance. So if that trade was smaller, where the risk wasn't so big, that would have been a good trade, right? But he had to close it down. He had to. There's just too much risk there to not close it down. We also have that inverted head and shoulders. Thank you. Now that inverted head and shoulders back here, there's the left shoulder, the head, the right shoulder, and the target on that. Some argue that it should be 50%, and some argue that it should be 100%. We made it 100%. Turn that right extension on. It is kind of hard to see that in it. When you zoom into a head and shoulders, it almost disappears, right? So you kind of have to look at it from a zoomed out perspective. So here's the head and shoulders. To make it easier for you to see, let's first get rid of that flag back there. I guess we kind of need some of that flag. All right. So there you go. First, get rid of that and then bring in the shapes. So here's the left shoulder, and then here's the right shoulder, and here was the head. Right now, a lot of people that draw a head and shoulders setup to kind of point out to people, hey, look, there's a head and shoulders forming. They usually use like a curve like this. So they'll say, left shoulder, head, right shoulder, and they're looking for a neckline break for a trade entry. So a lot of people like to get in down here as it's breaking the neck. And the target is the 200. We got that target because we measured the low of the left shoulder and the highest point of the head. So from 0 to 100. And then we plotted that down here. Here's the 50%, and there's the 100%. Easy, easy, right? So the head and shoulders was done. We'd already managed all of that. And now we've been getting higher lows and higher highs since then. on the intraday here, five-minute open range, broke out with a Busby, stalled around the econ time frame. So we had economic news come out, broke into an impulse move with trend, caught up into the next area of resistance. Very nice. Now markets aggregate. So what that means is we often see these megaphone patterns. Let's go back to a 5-minute so that we can snap our Fibonacci. We need a red candle past 10 a.m. So this red candle is too soon. It's only 15 minutes on a 5-minute chart. We need more than that, right? This is the first candle past 10 a.m. on a 5-minute chart. That's where we can first snap our fib. Now, if I went back to the 1-minute, we could use this candle because it would be 1-minute candles for, that's 15 candles worth of price action. It would be enough. But I've been teaching people to use the intraday fib by using a 5-minute chart. So we want to continue to do that. Once you get good at fib, you can swap whatever time frame you want. You can take what you learn and take it anywhere, right? But until then, I just teach everybody on the 5-minute. It's very structured and simple. There's no doubt, confusion, ambiguity. So 5-minute chart, intraday drawing only. Notice I didn't use any Globex. From the lowest point to the candle before the red or before the color change, right? If we were bearish, it would be the candle before the first green candle. So that red candle closing gave us permission to snap that fib. And we now have our warning center at 111. We have resistance at 100, support at 786, and we have a price target at 1236. Everything we need to trade this is all right there. Support, resistance, warning, target. That works in anything, by the way. So you can take this back to the futures. You can apply this, on the S&P or the NASDAQ, which, speaking of the S&P, we've got a very nice bear pennant failing, right? So I'll just use the SPX. Look at that. That is a very beautiful price action. And look at what it stopped at. Now, it didn't stop on a dime because markets just shouldn't behave that way, right? It went lower than the close, but that was the turning point. So basically, gap close. Now it's on the run, making a move, and it's coming into a resistance area where we opened. It's an institutional pivot point. We're very likely to see this market respond at this pivot point. You can see how we've been getting those higher lows and higher highs. Now we've made it through the open, so we're done with that institutional pivot point, and we now need to worry about the 5-minute open range again. The open range is a fairly good size range this morning. Now we do need to be concerned that this is presenting a Busby. So when you have a range like the 5-minute and then we broke underneath it or we broke through that range, what we need to be concerned of is that price comes up and tags the bottom of that range and then continues that move to the downside. If we do get a Busby here, the target will be back down to 47.66. So at least you know where we're headed. The NDX or the NASDAQ or the NQ, depending on the product you want to trade, it also came down and closed that gap. Look at that. And then people wonder why I'm a pivot point trader. Um, that right there. On the upside move, where did we get to? Yesterday's high. Did we stop on a dime? No. But I mean, that's an unrealistic assumption, anyways. Rejected on yesterday's high, came down and tagged yesterday's close. Pivot points are a really great way to trade. They give you perspective. Where is the market right now? They give you context. Where are we going? Are we moving away from one of these moving averages or one of these pivot points or one of these marks from yesterday? Or are we moving towards one? And when we get there, what do we expect is going to happen? Is it going to get there and reject? First touch says yes. First touch says when we get there the first time, we're going to reject. Don't know what's going to happen after that, but you can at least get one good bounce a lot of times. Way more than that trade works more often than it doesn't work. Let's say it that way. Energy is still looking really good. You could almost argue that it isn't a trend at all, right? That it was more of an impulse move. Let's kind of bring it out to the higher time frame here for a moment. So we got an inverted head and shoulders here on energy. This is the XOP, oil and gas exploration. And again, I get it. I know it's a little hard to see a head and shoulders, especially if you try to zoom in. Like a left shoulder, head, right shoulder, neckline break. And it's ugly. Don't even send me the message, right? Like I don't see it. It's ugly. It's real ugly. I get it. It is. But it's still there. Even an ugly pattern is still a pattern. The thing is, ugly doesn't mean we can't trade it. It's just a warning that we may want to size down a little bit. We may not want to do it in as big of a position that we normally would take, right? Because the pattern is more unclear. That's a very beautiful move, though. Airlines as well. Consistent, persistent move to the downside. We closed that gap that was left behind back here. We have a double bottom that went just a little bit deeper. We've got a lot of patterns here. And we had a really good trade setup. Yesterday was a red day, not just a red day, a very small red day. But we had a red to green setup, an inside day breakout setup, and a rally through the last major pivot. All of that. And this thing is still on the run. It is very close to that 4% move that I was talking about earlier. So I would not try to get into it now unless you're going to do something like a swing trade. There was talk that I was going to be streaming in the futures on Mondays in the new year, but that was dependent on Tim streaming in the large caps on Mondays. And from what I can tell, he'll be streaming on Thursdays and Fridays, not on Mondays. So if he's not here to stream in the large caps, then I won't be streaming in the futures. We had a pretty good looking red to green showing up on technology, but now we're back inside of yesterday's price action. So in the pre-market, it was looking pretty good. Faded down before the open. A lot of violence on each side, and now we're just sitting in the middle like we're waiting on something. And there goes the indexes again. NASDAQ and the S&P fading off. There are only 243 companies in the S&P 500 that are advancing at the moment. IGV is the ETF that I use to monitor like really big tech names. It's called Expanded Tech Software. So you can see it's got Adobe, Salesforce, Microsoft, Oracle, Zoom, Activision, um, Inuit Software, and now ServiceNow. They all have that failed flag, failed pennant setup. It hasn't failed yet. We were looking for it to fail, right? Because it's extending too long. So these are all priming up for a trade opportunity. You could just go to IGV and trade the ETF itself, or you could get more specific and trade names inside of it that suit you better. Cloud computing is another one that I use much the same way. The names inside of cloud ETF are big names: Tech, Zoom, Twilo, Shop, WDay, Netflix, Plan, Dropbox. Now, Plan has almost given us a V bottom, but a lot of these other ones are still failed flag, or presenting a flag that has not yet failed. Twilo has the flag and the breakout and the Busby. So let's go take a look at Twilo. That's actually the follow through that we're looking for on the other names. All right, so we had the trend to the downside, and then that downward trend ends. It starts to build a base. We look for that base to maintain between the 78.6 and the 100 fib. So it's building that base down there, breaks out, rolls over, gives us a Busby, and then we're expecting this to reciprocate back up to those previous levels. That's the trade setup. But look at the warning being presented here. It has the move to the downside. It built a really good base. The breakout was clean, and then everything went to hell, right? So take a pause at that point, because that was a really important piece right there. Everything looks perfect. It hit that orange line, which is the 50 period, begins to reject, and that's fine because we're expecting a Busby. right? So this is supposed to make a move up and then fade back down and bounce. That's what we were expecting to see. Instead, it started to fade back down and find an early support around that 70 line. So now we bring the base up and we say, okay, well, then, there's our base and there's our Busby. Okay. Well, a Busby only owes you back to the top. And it did that. So there's our bounce. There's our completion of the Busby. The trade is done. If we're still looking for the failed flag play to get back up to these previous levels, it's not going to be connected to that Busby because the Busby's done. Then we fade off again. We retest that lower base that we had drawn. And then we get that rally up. And it is also completed. It made the move that it was supposed to make. Anything extra will have to be based on its now values, not based on this failed flag and not based on that Busby. All of that is done. So you're going to want to focus your attention on whatever we have coming through lunch. It's 10:30. We're very close to lunch. We have additional auctions at 11:30. This could grind its way up to 267, but I wouldn't want to take a day trade in a grind of this cost. W Day's got a lot of compression. Check that out. So nice move to the downside. It paused to consolidate, and it is just winding up more and more and more energy. That thing is getting ready to make a move. Now, there's no promise about what direction it's going to go, right? It doesn't, it's not making that distinction, just that it's building up a lot of energy right there. Plan is starting to expand after doing the same thing. You can see how plan stopped here, set the range, wound up nicely, and now it's making its move. Dropbox also making the move. ZS is a picture perfect flag, but it hasn't failed yet. It's still just sitting in that range. The longer it sits here, though, the more likely it is going to fail. And flag failure, when it's a bear flag, really does mean we're expecting it to go up. If this bear flag did not fail, then we would expect it to go down because a flag is a continuation play. When that continuation is a failure, then we expect a market reversal. Man, that move in the dollar is extreme. If you guys are trading the futures, that's a really good market to keep your eye on. The dollar and the bonds, the dollar and the bonds. When these two make exaggerated moves, it is very likely to have an impact on our market. It's not going to tell you to get in or get out. It's not going to give you an idea of taking a trade, right? But it is going to provide some context. Small caps, yep. Someone gave a shout out on that. Small caps are on the run. Absolutely phenomenal move in the market. But these are exaggerated extremes, right? Look at that fade in the bonds and that move in the dollar. So this should cause you concern. JP Morgan is continuing that move to the upside. Let's see if I can sell one of those calls yet. Remember that I bought a call in JP Morgan this morning. Not yet. I can't sell against it yet. The one that I bought, I paid 30 $38 for it. At $76, I will have made 100% profit. Woohoo! I made 100% profit. I don't think I'm going to keep it though, which is why I'm trying to sell a call for at least as much money as the one that I bought, which would give me a no lose trade. And I would just be sitting in a pretty good spot. If I close this right now, I can lock in my gains, but one, I would lose the opportunity to perhaps make more money. And two, I would get a PDT. Well, we only get 3 of those in a small account, right? I don't know that I necessarily want to waste a PDT on just a straight call like this. I'd rather save those and use them for like a credit spread or something. And this is a super small account, right? Because I don't do a lot of trading on my Thinkorswim. So I don't keep it funded with a lot of money. Yeah, it's got a $125 account, right? You can see it's a very small account. So we almost hit 100% profit, though. I just seen the mark went to 78. Now I bought it at 38. So $76 is 100% profit. If I can make that 100% profit, then that's a good trade. What I'd like to be able to do is lock in my gains and sell a call against it. That way I don't have to worry about this thing stalling out. So I'm going to take this call and throw it into the Analyze tab and ask the question, well, what would happen if I added that short leg? And that way we can visually see what my max risk in this trade would be at that point. Right now, I'm risking $38 because that's what I spent to buy that original call. If I add a short leg, I will cap my max profit, but I will eliminate some of that risk. Right now, I would eliminate about 50% of my risk. If I could sell that short leg for more than I spent on the long leg, then I would be in a free trade with no risk whatsoever. But we're not there yet. And we may not get there. We're underneath the 50. We're underneath the 100. And both of those should cause concern, right? Plus, we've got earnings coming up. I'm going to go with $78. $76 would be 100% profit, and the additional $2 would cover my commissions. Now, the argument could be made that I'm being a little greedy and that it would be better to close it down before I lose my opportunity to lock in gains. And this is the struggle when you have a single option, right? If I had bought more than one, I could lock in some of the gains and leave the other one on, right? That would be a better way to do business. But it's such a small account, I didn't want to buy more than one. we're getting a new push in the financials. That's why I paused here instead of hitting the go button. So I'm going to close it at 48, excuse me, at $78. That would be 100% profit. And boom, look at that. I got closed immediately. So the mark says 75. Um, I closed at 78. That thing is pricing at 80 now. And I made 100% profit on my trade. That is a live account, a live trade, right? If I was on paper, it would have that orange kind of background around it, right? You can always recognize when someone is on Thinkorswim paper. So, it's good enough. It's a nice start to the week, nice little 100% profit. I didn't make very much. I don't think I could get the family a bunch of frappe at McDonald's for the amount of money that I just made. But this little bitty account just grew quite a bit, right? Now it's a $200 account. Woohoo. I did speak about 0 days. We're looking at the SPX. We had that really strong range of resistance all through the holidays. We managed to break out of that Friday, and now we're sitting inside of Friday's price action. One good thing of note right off the top is in that gapped up move from Friday, we didn't dump back down. That's a good heads up because we see that a lot, right? A market that gaps up and then just dumps back down after hitting new highs. Um, Primarily, I use Tastyworks. When I first started trading, I was on Robinhood because I was new and I didn't know any better. And then I wanted more than Robinhood could offer, and I came to Thinkorswim. I was already using Thinkorswim to do all of my analysis, so I started doing my trading there as well. But I really hate how Thinkorswim is shows you your trade, right? I mean, it was not was, it is difficult to see what your risk is, what your reward is, what your average win rate is. Like, just, I don't know, maybe I got spoiled by having, a different broker show me P&L, but Thinkorswim does a horrible, horrible job of that. So I started looking around and I found Tastyworks, and Tastyworks is a really great platform. It's nice and clean. It's super fast. Made by the same people who made Thinkorswim, Tom Sosnoff and crew. This thing, plus they have commissions that are I limit it at 10. So if I trade one contract or uh, 10 contracts, I pay commissions. But if I trade anything above 10, commissions stop at 10. So I can put on a trade with, 50 calls. I'm only paying for 10. It does a really good job of showing the trade that I'm in. This trade price, for an example, is green if I sold it. It's red if I bought it. I can see the current right now mark. So I sold this for 312. Right now, if I wanted to close it, it would cost me 403. I'm down 29% in the trade. I can put that into dollar values, right? And say I'm down, $73. Uh, Total P&L since opening everything is just nice, clean right there. When I'm building a trade, I don't always know exactly what I want to build yet. So sometimes, say we start with a credit spread and we throw it over to the analyzer and we're looking at it and like, no, maybe I want to go a little bigger. Boom, and just make it a little bigger, just like that. instantly updated. How much extrinsic value is in it? What's my pop? What's my P50? P50 means what's the likelihood that I'll hit 50% profit. I can see the one standard deviation move, a two standard deviation move. I've got the bell curve plotted, the current P&L plotted, and it visually shows me everything right there. It's a credit spread with this much money, that much risk for that much reward. And it will instantly update if I change one thing. Gosh, I love that. And commission wise, it's no worse than any of your other brokers out there. I mean, they're not, they're not like the cheapest commissions in the world, but they're not gouging you. I totally love this platform. Um, I do trade other places, but this is my main. And I've got more than one account here. So I've got like a retirement account, a regular account, but then on two different names too. Because um, yeah, I love it. Yeah, and it's fast too. I mean, most of the brokers nowadays have a respective fill rate, and they're all pretty comparable. Um, they have recently upgraded their intraday monitoring stuff. So if you're going to do something like a 0 day, you have to definitely make sure you go to their website. It's a super easy thing to do. You just log in on the website and it'll have this button that says something about your trade is going to expire today and we're watching it. Are you going to manage it on your own? Yes or no? And if you tell them, yeah, yeah, hey, I'm watching this, don't close my trade, then they won't close it. But if you don't tell them that, sometime after 3 o'clock, your trade is just randomly going to close. And that sucks. They're not the only one that does that. A lot of brokerages do that, but it didn't used to be so aggressive. Now, now they do that a lot more aggressive than they used to, which is why they had to activate that button, right? So you go into something like maybe it's in trading preferences. Yeah, right there. So you go to trading preferences and you just tell them, hey, I'm monitoring this. I've got it. Don't close my trade. And then, no problem. They won't close it. But if you don't do this in your 0 day trading, you're very likely to get a trade closed on you. And that's just really frustrating. I had that happen to me in Google not too long ago. It was a 0 day. I was in like 7 credit spreads that were going to expire on that day in Google. And yeah, they closed them on me. Just poof. That sucks. It is a really nice platform and it has the tasty stream. So you can like watch the live stream in there. And then you can go and look at what Tom has been trading or Bat, right? Jen and Lizzie, any of the crew, their trades are on there. This was interesting because like I'm stuck in my ways. I like to do, at the money credit spreads, things like that. But we need to adapt for different market environments. There is times where we may want to go farther out or shorter in, or we may want to go, at the money or out of the money. When I see the different ways that they trade, it often makes me question like, man, why they do it like that? And then I dig into it and I find a new setup or a new way to build a trade, a different time to take a strangle or a straddle. So I don't mimic what they do, but oftentimes I'll go in and rebuild what I seen that they did do, kind of asking the question like, why did they do it that way? So this is really cool. And then on the website, if you log into Tastyworks Brokerage online, it has a built-in trade journal and it beta weighs your portfolio automatically and presents it at the top of the screen, which is really nice because then you've got like your aggregated risk metric right in your face. So I totally love the broker. It is not my go-to for day trading, and I definitely don't trade futures here. But I do trade the micro, or not the micro, the smalls. So they have those new smalls products, the smalls exchange, and I trade these here. On Trade you can't trade the smalls anymore. You have to trade the Fair X, which is the other new futures that are out. Fair X is made by Bloomberg. The smalls are made by Tastyworks. And I don't know why they couldn't let us do both, but they won't. So you can learn more about both of those if you go to like FairX Futures or FairX Exchange. And like I said, these are made by Bloomberg. These are not necessarily something you would want to day trade in futures. They're more of like a swing trade in futures. But there's FairX and then there's Smalls Exchange. And for me, I'm willing to trade anything as long as I can grasp my risk and understand, the risk and reward metrics and the opportunities presented. So those two are really great futures trade products that kind of back away from that day trade in the futures, right? Because I mean, I like to day trade, don't get me wrong, but there are times where day trading just doesn't fit, right? Like that exaggerated move we had this morning in the futures. If I was wanting to day trade in the futures and we're getting 1 minute candles of this magnitude, you got to look at that and be like, there is no way I can trade this with a risk level that I'm comfortable with. You know what I mean? Like, how big of a stop do you need when your 1 minute candles are 15 points wide? That's a monster. So uh, swapping products, being able to understand the opportunities that are out there and just go to something with less risk. Plus, I like to trade options on futures, and Tastyworks does a really good job showing me those options values because options on futures are tricky. They're a little complicated compared to like regular futures. Oh, I think I broke it. So if we wanted to trade futures and we looked at it on a regular broker, this says that the mid is $24. Say I want to sell a put on the ES, 23.75, $24. We'll just lock it at $24. What how much money am I actually getting and what do I have at risk? Now I can hit confirm and send and I can kind of validate. Okay, I'm selling that for $1,200 credit. But it says $24. How's it getting 1,200? That's because when you trade futures, you cut the number in half. So we see 24, cut that in half, and we say 12. Okay, 12 $12 credit is $1,200 credit. So it can be a little confusing. Um, I sell options on the MES, not the ES, because the ES is just too big. But rather than selling a put in SPY, sell a put in here. Max profit, $120, 1/10 the size, right? Instead of 1,200, 120. But selling a put in the MES has a much smaller buying power reduction than selling a put in SPY. You can sell like 4 MES puts for the cost of selling one SPY put. Well, I mean, they're both fine. I do use Tastyworks for trading options on futures. It is who I use, only because I don't have to do that math in my head about, cutting it in half and looking at the risk and clicking the button to see that risk. If I do that trade on Tastyworks, it's just right there. It shows me exactly what the risk and reward is. Right. So, here we are on the MES. I come in and want to look at selling a put there. There's my max loss and my max profit. I don't have to go hunting for that information. It's right there. So this is the broker that I use to trade those futures, the options on the futures. So big distinction. When we trade futures, we're trading futures. When we trade options on futures, we're trading options on futures. I do not trade futures here, but I do trade options on futures here. When I'm trading futures, I use my futures broker, Tradeovate. We actually had a Bullish Bears member that had an enormous account, and they thought that we were trading options on futures. And that guy was actually going in trading the options, not the futures. Now he was making a killing, but he didn't understand that we were all trading futures and he was trading options on futures. The guy was buying calls and puts, and we were just straight up trading futures. Now, thankfully, he didn't get hurt, but he was way off mark, right? When you're trading futures, you're trading the futures contract. No, there's no call, no put, no Greeks. You're just straight up buying a futures contract. It's like buying a stock. Options are options. Everything else is everything else. And Tastyworks does have options. Um, I haven't traded any here. But as you can see, they do have options. All right. Well, the Nasdaq recovered from that drop this morning from the gap close. The S&P kind of recovered, but it's still sitting inside of that 5-minute open range. So it's more of that same old thing from last week. We're just kind of holding the levels. We're not doing much. And it is worth noting that we were looking at um, a real lack of volume. So you can kind of see in the grand scheme of things, the volume was picking up in the earlier part of December. It faded off, and then we've been kind of holding, near or below that 60 level. That's a low volume environment. So we're looking to see this change kind of come back around today. I had a question about the uh, the futures and quote other stuff. So a really good way to do this is to recognize that there are different things. Here is, for an example, the NDX. This is the NASDAQ 100 index. There's no stock. Notice that the volume disappeared down here. There's no volume. Now, we can trade options in the NASDAQ, but we can't own the NASDAQ, right? We can't buy stock in it. If I go to the QQQ, this is also the NASDAQ, but this is a man-made version of the NASDAQ. So a company out there called Invesco built an ETF designed to mimic the NDX. It has shares, it has dividends, you can own it, you can invest in it for the long term, and you can trade options in it. The NQ, this is the futures. Notice it says March. This is the forward future price of where we think the NASDAQ will be in March. It is the future cost, the future expected value of the NASDAQ. So this is the futures product. The NDX is the index. The QQQ is a homemade, man-made version designed to mimic it so that you can invest in it, buy it, own it, whatever. Now, each one of those have their own risk, their own reward. They price in different ways. Their size makes them bigger or smaller in that risk metric, and you can choose to trade various ones depending on if you're an options trader or a futures trader or a stock trader. Depends on, are you trying to build a portfolio, a retirement portfolio, or are you just trying to take a trade? And then from those, you make the decision about which one it is that you would rather trade. There are micro versions. So, like the MNQ, that's the futures. It's just 1/10 the size of the minis. It's called a micro. In the NASDAQ, the NDX, well, there is a micro for that as well. And it's also 1/10 the size. And it's also so that you can participate in the NASDAQ in a much smaller scale. The SPX is exactly the same thing. So you've got the SPX. This is the S&P 500 index. There's no stock. You can't own it, but you could trade it with options. SPY is what people use when they want to trade and own the S&P 500. It's made by a company called Spider. You can go to the Spider website. They've got all kinds of really neat tools and different ways to aggregate the things that are inside of this, but they made it. They monitor and maintain it and try to make it mimic the SPX. It may be something that you want to use for a benchmark, for a retirement account, to day trade. It's one of the most liquid things in the marketplace today. And every time they want to experiment with new stuff, when they try out new ideas, and this is where they go. They start here, and if they like what they see, it branches out into different things. The SPY, for an example, was one of the first products to have 3 expirations in a week. And it was like that for years and years. And then in the later part of 2021, we started to see expirations 3 times a week in the NASDAQ and in the Russell as well. So they tested it here. They liked what happened. And now they're branching that out and making it bigger. It is one of the oldest and most venerated markets around the world. Everybody benchmarks against this, and it is one of the most liquid products that you could ever trade in your life. So if you are wanting to day trade and this was the only thing that you ever day traded, you would be in a much better position than someone who's attempting to day trade any old random stuff without understanding the dangers of a day trade. Mainly, for an example, liquidity. The bid ask spread is so tight that you can market order in SPY and really not give up much of a position. If you try to market order into Bank of America, you're liable to slip $5 to get in, $5 to get out, and that adds up really quick. By the end of the year, You don't see that you lost that money, but I'm telling you, you give away thousands at the end of the year doing that. Options on futures are not very liquid, right? So, as I was making the distinction earlier, people who trade futures should just trade futures. If you want to be an options trader and then trade options on futures, you better know what you're doing, or you're just going to get kicked in the face and lose your money. So if you're thinking, man, yeah, I would love to trade options on futures, you better understand very, very specifically how to trade options. And that should be the last thing that you would want to do is trade a futures product. Even the fact that you're asking me about the liquidity of those three tells me you don't know enough about them to trade them and that you should be very, very cautious before you attempt it. But which one is more liquid? Rather than guessing, or rather than you having to hope that I'm streaming so that you can catch me and get an answer, you could come in and look at the volume. And then you could also look at something like the open interest. So if I look at the volume and the open interest in the options on the futures right now, we can see single digits, a couple of double digits, not very liquid, right? I mean, this thing's screaming at us like, don't trade this thing, super dangerous, no liquidity. Look at the bid ask spread, $3 wide, $3. And some fool out there who trades is going to just market order into it rather than trying to work the order. Susquehanna is going to give it to them for 91.75 and then turn right around and pick it right back up on the mid, in and out. And they just made $200 on that person and they didn't even have to take a direction. So it's very illiquid, not a lot of volume. The NASDAQ futures would be the bottom of that list. What's the next one out of the liquidity? Well, there's QQQ and NDX. We don't have to guess or assume. We can just go right over to the QQQs and we can start looking at some of these. Open interest, triple digits. It's in the thousands, not on one strike, but on multiple strikes. I can look up and down the options chain. I can see plenty of volume, plenty of open interest. So right off the bat, we know that this is way more liquid than the NASDAQ. And then look at the bid ask spread, 2 pennies, 3 pennies, 5 pennies. Okay, I mean, that's not bad. Lots of liquidity, lots of action, tight bid ask spread, lots of open interest. Let's go to the NDX. A really wide bid ask spread, single digits in the open interest, single digits in the volume. Now, which one of those are more liquid? You'll never have to ask that question again because now you know how to identify which one of those are more liquid. The QQQ. How were we able to discern that? Go to the options chain, look at all three products side by side, check multiple strikes in multiple expirations, and get a feel for its liquidity. We can look at the bid ask spread, we can look at the open interest, and we can look at today's volume. Now, remember, it won't always be this way, right? We could argue maybe it's only liquid because it's the end of the year, or there was an earnings, or right, maybe there was a delivery like on Tesla. So today we're talking about the NASDAQ and the indexes, but what if it was Apple or X Steel, right? So don't trust that the liquidity that you see right now is the liquidity that you would always see. Now, as you get more comfortable trading it, you will recognize the names that are, quote, always liquid. But I can tell you, when we crashed during Corona, you couldn't get out of SPY, right? It wasn't liquid enough to even do that. You were stuck in it. And like, it didn't matter how good you were as a trader, it didn't matter how many years of experience you had, you couldn't get filled. So recognize that liquidity is not an always thing, and that we can always check. We can just bring up different underlyings and look at their liquidity. And then we can make an informed decision about, well, which one is more liquid. What we don't want to do is be stuck hoping that we can trade the liquid one. Hope is real, but it is not a good trade strategy. Before the micro futures came out, you could only trade the futures in big size, ES, NQ. And that left a lot of people sitting on the sidelines. It was just too expensive, right? The risk was too big. And so most of us non-futures traders who aspired to be futures traders, we were trading QQQ and SPY. The reason for that is if you can trade those consistently on an intraday basis, then you can trade the futures. That's a really good thing to know. They move the same way, they act the same way, your trade strategies are exactly the same. So those of us who knew the micros were coming, we were practicing our futures trading in SPY because we all knew, like, okay, May 2019, we're going to get these micros. And man, we were so excited. We're like, yes, I can't wait. But we wanted to get ahead of the game, right? We wanted to know that we had strategies that worked. So we were trading in the Qs and in SPY, practicing for the day when those futures came out. I know clients who cannot have a futures brokerage. One, because maybe the country they live in, or two, because of the money that they're using is locked into an account and they can't take it out of that account and go somewhere else. And for those people who wanted to trade futures but can't, we focus on the Qs and on SPY for that. And that way they're kind of doing the same thing, right? They're trading the same thing we're trading. They're just doing it in those ETFs instead. So futures are big, they hurt. But with these new micros, the hurt is a lot smaller. And there's a lot of brokers now that you can open with like $300. So there really is no limitation now compared to the way it used to be. Now anybody can participate in the futures market. If you can open an account with $300, you're good to go. Right. And I mean, it's going to be difficult because it's such a small account, but the setups that you would trade are not handicapped by that small size, right? Like if you're trading a failed flag, you would still be able to do it with a $300 account. A lot of options trades that I would like to show people, you can't do them in a particular size account. Like, oh, my account's too small, I can't do that trade. Well, that sucks. But in futures, that's not true. The only thing that will handicap you with a small account in futures is holding into the close. You have to make sure that you're out of your trade by the end of the day. And it all comes down to buying power reduction. In the futures, in those small accounts that are out there, we call them the small brokers. If you're trading in the futures, you can get into a market for $55 of buying power reduction. So you don't even buy anything, they're just withholding $55. But at the end of the day, when you go into the close, suddenly your buying power goes from $55 to $1,800. Well, if you're in a small account, $55 is easy to carry. Go into the close, and now you don't have $2,000. They're going to liquidate your trade, and then they're going to bill you $50 for liquidating your trade. And now your small account just got smaller. That's right, no PDT, so you don't have to worry about that. All you have to worry about is do not hold into the close. That's the number one thing. They close to us, they close at 4. In reality, they close at 5, and then they open up for everybody at 6 o'clock at night. So from 6 at night until 4 the next day, you can trade. That's 22 hours that you can trade. And liquidity in the futures is not liquidity in stock, right? In stock, if there's 100,000 share float, then that's all there is. In the futures, if they need another futures contract, they just make another one. Poof, ta-da, you got another one. There is no lack of liquidity. So you can trade at night just as easily as you can in the daytime. They're liquid. You can get in and out. And you can literally trade 22 hours a day, which is awesome because if you still have a day job, you could trade at night. If you are a single parent and the kids are keeping you busy during the day, you could trade at night. You know what I mean? Like there's no PDT, it's cash settled, it's leveraged, great for small accounts, open 22 hours a day. It is the perfect vehicle for day trading. Nothing comes close to doing that. Nothing. Which is why when those micros came out, I really backed away from day trading options. I still day trade options. I still love my options, but the bulk of my day trading is done in the futures. That way, I'm day done by 8 a.m. every day, and I just go do something else for the rest of the day. Well, it's hard to say. Um, so I'm really good at math, and I didn't have a problem with options. So when I approached options as a beginner, I didn't have I wasn't even trading a month before I was doing options in spreads. And I gravitated to it very easy, no problem. And the really good thing about options is you don't have to trade directionally, right? And you didn't mention day trading. You just asked what's better for beginners. So, when it comes to trading, if you can trade non-directionally, you can win more often, right? And you can grow. So options are great if you don't trade directionally. If you're trying to day trade, well, hands down, nothing is better to day trade than a futures contract. So if you're a beginner looking to day trade, I would say do futures. But if you're just a beginner wanting to trade something and you don't really care if it's a day trade or not, I would say options. But I've met people who told me math is stupid. Okay, well, if you think math is stupid, maybe not options, right? I've had people say options are really, really confusing and I just don't get it. And I've tried and tried and I just don't get it. Okay, don't do options, right? I was a beginner and I found options to be very simple, very easy, and I learned them very fast. But not everybody's that way. Price is price is price. So if you're trading directionally, anything that is a directional trade would work. The cool thing about options is you don't have to be directional. Even if you do options in a 0 day. So it is a day trade, but it is a specific kind of day trade. So take the SPX. We could make $10,000 today in the SPX, even if this thing doesn't go anywhere. It doesn't have to go anywhere. We can just straight up make $10,000 and this thing doesn't have to do anything. Just like that. I didn't have to hunt for momentum. I didn't have to catch it while it's trending. All I have to do is come in and put on a 0 day trade in the SPX and make $10,000. That's not an exaggerated number, by the way. You get what you risk in a 0 day trade. So if you want to, say, risk 5,000 to make 5,000, you can do that. You want to risk 3,000 to make 3,000? Yeah, you can do that too. You choose the size. How much money would you like to make today? And then that's the size of the trade that you put on. And you could totally do it non-directionally, so where the market doesn't have to do a darn thing. So what if we were just to come in here and build a $50 wide credit spread? That is $2,000 to $700 in credit right there. So we're risking 2,300 to make 2,700. This will pay by the end of the day. The break even for this trade, 4,772. So the market would need to run another dollar and quarter or this would lose. So this one needs the market to move. Let's make an adjustment where we find one the market does not need to move. We'll just knock it down, say to 10 points, 10 points lower. It's still 50 points wide. Now we're getting a little less credit. This one has a break even of 47.70. Hey, that's where we're at, 47.70. So as long as the market stays where it is or goes up from here, we would make $2,000 today, and it wouldn't matter if the market moved all the way to the moon or just went up $1. It would still make $2,000 by the end of the day. So, when I hear that question, well, what should a new trader do? I'm new, I'm a beginner. What should I do? It depends on how smart you are, how fast you are at learning, how much time you're willing to put into it. Right? If we're talking about a directional day trade, you should probably do futures. It's designed to be day traded. But if you're just straight up wanting to have a way of trading, options are easier to win. And just like I demonstrated right here, you can make really good money trading options. It doesn't need no momentum. It doesn't need trend. Hell, you don't even have to pick a direction. But what really helps is if you look at what your account size is and you look at any of your restrictions in your own life. So, for an example, people in Canada. I don't know why the American system discriminates against Canadians, but man, it does. So, if you're in Canada, your choices of brokerages is very, very limited. That's just the way it is. Knowing that options may not be your first choice because you're stuck on one platform, IBKR, and it's not easy to learn IBKR. And then, adding options on top of that, options are not easy to learn. So then you've got a broker that isn't very user friendly trying to learn options, and that just sucks. So, look at what your life is, look at what you're trying to accomplish with the amount of money that you have, and then start asking questions. I started with $300 and I live in America, so I can choose any broker that I want. And my goal was to grow that $300 out. So obviously, long-term 6-month buy and hold is not a really good idea because I only had $300. It would take me a lifetime to grow that $300 out. But I meet people every day that are starting with 300,000 and 400,000 and $900,000. Well, then don't day trade, for goodness sakes. If you got that much money, put that money to work. There's no reason to day trade and take such risk. So, such a vague question. Where should a beginner start? Start with what helps you reach your account goals. And your account goals should be based on your life and your needs. Because at the end of the day, trading is very hard. All of it. Stocks, options, futures, options on futures, Forex, Bitcoin, all of it. It's all hard. And it's all risk and it's all loss. Me too. Yep. I was trading in the nighttime and I was trading in the mornings. And then I was trading in the middle of the day. And it finally got to the point where my family asked, "Are you ever coming out of that freaking office?" So I quit trading at night and now I trade in the mornings and I trade during the day. Because just because these things are open 22 hours a day doesn't mean we should be trading it 22 hours a day. But it's perfect for someone with like, you know, a, a day job or, like I said, single parent with the kids. You get their needs taken care of, and then you have free time in the evening and you can trade afterwards. That's totally perfect. I hate the word easy. It doesn't fit well. I need a better word. I just don't have one. So I'm going to use easy, but I don't like it. When it comes to finding consistent trading, options in a swing trade, options in a longer duration is easier to do. When it comes to growing an account, long-term swing trades is easier to do. If you have a very large account, you should not be thinking about day trading if you're new. You should be thinking about like the wheel and stock and option strategies that put a lot of that capital to work, it will grow in a real low risk environment. It'll just grow and grow and grow. And you can't screw it up, right? Like you can just let that do its thing. And you could even break off a small chunk of it. Break off $1,000 out of a really big account and go day trade with that $1,000. At least that way, if you screw up, the worst that's going to happen, you're going to lose $1,000. I don't like to lose, but I'd rather lose 1,000 than lose my house. Right? I'd rather lose 1,000 than lose my entire savings, my entire livelihood, everything. So do that. But if you're in a small account, long-term swing trades take too long to rotate. You have to have capital rotation to grow an account. So if you're starting out with like $5,000 or $10,000, that's a small account. You've got to rotate that capital and get that capital to grow. So you would not want to do long-term 6-9 month trades in wheel strategies and things like that. You're going to want to come in, bring it into a shorter duration, and shorter duration is harder. The shorter the duration, the harder the trade. All right, guys, I'm going to get off of here. I've got somewhere to be in about a half hour. I want to stretch my legs and got running around. The idea was that Tim was going to be streaming mornings and that I would be doing afternoons where I come in live. We build swing trades. We analyze different options, trades, and setups. But I'm not going to stream all morning and then come in and stream in the afternoon. So that's just not happening. So I definitely won't be in this afternoon to do any live stream. Maybe tomorrow. When you're on the website, guys, by the way, we do have the new Discords coming, but I don't think they're open yet. So until they are, take advantage of the website, the Next Level Library. And I literally was recording a new video for this thing this morning. The amount of content in here is amazing. And we're constantly adding to it, making it more, making it better. So use the search feature in the upper right corner. Go through the courses, go through the Next Level Library, hunt for what you're looking for, and go to YouTube. We have a lot of content on the YouTube page. Just because it's a public post doesn't mean it isn't a valuable post. So, make sure you check all those places. When you're on YouTube, just use bullish bears in your search feature. Type in the words bullish bears and then whatever it is that you want to check. And you can see, I mean, we've got a lot of stuff on options, on futures, on day trading. If you're trading futures, don't think that you have to focus all your attention on a title that says futures. Because if you're day trading anything that uses price, whatever you will learn there, you can use in the futures. Strategies, 5-minute open range, failed flag, inside day breakouts, half day wedge breakouts. There's so many different strategies out there. All of them work whether you're in Apple or SPY or ES, right? It's the same setup.